Taxes suck, so here's how you pay less of them 100% legally using real estate, which is the most tax advantaged industry in the US if you know how to use it. And lucky for you, I really hate paying taxes. So I pay my accountants tens of thousands of dollars over the years so that I can understand what these hacks are and how to properly apply them. And I'm just gonna give you that information for free now. So get your pen and paper out. And before we start talking about tax hacks, I'm gonna give you something else for free. I'm gonna give you 25 free copies of the legendary rental property calculator or anything else from the Invest with Ace toolkit store. You can get there through our link in bio, through investwithace.com, or through this little link hovering over my head if you're watching the YouTube video. The coupon code is FTAXES, FTAXES, all lowercase, one word. I'll let you decide what the F stands for. Once the 25 free copies are redeemed, the coupon code does not work anymore, and it does go fast. It's not fake. There's a lot of people watching this video, so hit pause, jump on it. It's on multiple platforms. If you scramble, usually the Instagram version gets there first, you will get a free copy. It does not work for the course, and a little logical plug for the course here. It's the cost of a home inspection, the Virtual Investor's Guide. And it's our entire A to Z method on how we acquire properties on or off market, 100% remotely, out of state, and operate them. If you want to understand how to do any piece of that process and want to try it yourself, it's almost a guarantee that this thing will spare you from one burned home inspection, because you better analyze the property on the way in before you paid an inspector to go out there, and it'll automatically pay for itself on top of all the other value that it provides you. So I got a link for you there if you want to check that out. The whole curriculum is on the course site, so you can see the topic of every one of the 54 videos. It's like 8.5 hours of runtime, and it's quality stuff. It's not some schemy social media course. It's real substance from a real investor. But that's enough plugs. Let's jump right into it. I got a quick disclaimer for you, then we're going to talk tax hacks. I am not your CPA. I'm not anyone's CPA. I'm just not a CPA. I just talk to mine a lot, pay him a lot of money. I think I paid fucking $12,000 last year to my accountant. And a lot of it was coaching, consulting, and training my team. So we really try to understand how to maximize our tax situation here, but you got to take these ideas and talk to your accountant, put that time and effort in, develop that relationship with them, and figure out how to make these work for yourself, right? So don't just plug what I'm doing here into like a TurboTax next year. I don't advise it. But these methods do work, and using these really two categories of tax hacks and the little subcategories underneath them, I paid taxes on 1/3 of my true earnings last year, which is pretty dope. I think you guys would be pretty happy if you only had to do that as well. So the two categories of tax hacks that really every real estate investor uses the most are making money that you don't actually have to claim as income, so unrealized gain, and claiming losses on your tax returns, but it wasn't money you really lost. It's a non-cash loss. And I'm gonna go over the best ways to do this today, and kind of in simple form. We're gonna keep this short. Number one, earnings that you didn't claim. This is essentially equity in your property. It's value you gained in your property, so you're not paying taxes on it. And you can get it in three ways. The first way is that natural appreciation. You buy a property for 100K, after 10 years, it's worth 150. You've got $50,000 of additional equity. You made money on it, but the IRS doesn't see it as long as you hold on to the asset. You are $50,000 richer, but you didn't pay $1 in taxes. That is slow though. So a lot of people will try to accelerate how they get equity so they can get richer in tax-free ways faster. One popular way is value add. You buy the property for 50, you put 25 into it, you improve the interior, maybe the exterior a little bit, you increase the rents, you lower the expenses, and now your property's worth 125. Well, that 50K of equity you got in that property was quicker than the appreciation way, and it is also tax-free. But I like it even faster than that. My favorite way to get unrealized income is to buy properties as they stand at a discount from what they're worth today without me having to touch them before I spend $1 on them, right? And this isn't that easy, right? But the way that you get the discount factor is through the off-market deal. Getting a property through your own marketing, getting a property through wholesalers, through relationships, whatever it might be. Usually these don't come on the MLS. For less than what they're worth in their as-is condition is a great way to, I've bought many a house for 40,000, put 10 into it. I'm all in for 50. I just paint and floor the inside, and it's worth 110 as it is. I get 60K of equity really, really fast, and didn't have to do a whole lot to get it. And it's all tax-free. Now, I've got a little bonus hack for you when it comes to discount factor. This is one of my favorite methods since interest rates have gone up, because when you don't have as much debt, you don't buy as much property, so you got to find more creative ways to get your tax hacks. I call this the ACE shuffle. Now, I got a buddy who's a big developer that calls it stacking his basis. I haven't been able to find an official name for this in the real estate investing community. I've Googled, I've looked at forums, all that stuff. So call it what you want to call it. I'm calling it the ACE shuffle, but I'll illustrate it for you. Let's say you have someone that brings you an off-market deal. It's a good deal. It's 4 houses for $300,000. Now, they don't care how you divide the price up. They just want $300,000 for the pack. It's a package price. Maybe one of the properties has some explanation for why it would be worth some amount less than the others, right? And it's got to be justifiable. And maybe you want to keep one and you want to flip the other 3 properties. Well, you have a couple ways of doing this. You can buy them all for $75 each, and you can flip those 3. Maybe they're worth $100. Maybe it's a discounted deal. And you make 25, 25, 25 on the 3 you flip. That's $75. It is taxed, but it pays for the $75,000 property, but you're still paying taxes. Or you can buy the 3 properties that are perhaps better, so they have some explanation for why they're worth more, for $99 each. And you only make $1,000 on each when you flip them. So you don't pay really any taxes, because the closing costs will eat that up, right? And then you get the other property for $3,000 because it has some substantial work that it needs. Now, I'm illustrating an extreme here, but that $3,000 property had all the profits pushed into it. You bought it for only 3. You got a ton of equity in this thing, a lot of unrealized income. The income never hit the books, and you essentially got a free property. Your net worth increased by $97,000 if you didn't pay $1 of taxes on the whole thing. That's the ACE shuffle, or stacking your basis, or whatever you want to call it. It's great for packs. It's great if you wholesale or resell deals. It gives you a lot of flexibility in controlling your taxable income, as long as you have a good reason for why things were priced the way that they were. So now you have all this equity, right? And it's all tied up in your net worth. That's great. You are richer. You didn't pay taxes on it. But what if you want to access it? You guys are probably like, well, shit, it's all tied up. How do I turn it into cash without paying taxes? Well, if you sell it, you pay taxes. But if you refinance, if you get a loan on, let's say, you have $1 million portfolio, it's all paid off. You go to the bank, you say, give me $500,000. Debt is non-taxable. You can get a check from the bank for $500,000. You got to pay that loan back off, but your tenants are going to pay it, right? It's not going to be you if these are rental properties. And that check gets deposited in your account. You don't pay $1 in taxes on it. Now you have $500,000 to play with to go get more unrealized gains, more deals at discounts, more ACE shuffles, and you keep the snowball rolling. That's one way to do it. The other way to do it is to 1031 exchange out of these properties. It's a way of selling a property and trading it for another one, as long as you adhere to some requirements and some tight timelines to make sure you find an adequate replacement to move the money into. You can't touch the money. You have to use an intermediary when you sell the property to hold on to the cash until you find the replacement and close on it. But using a 1031 exchange is going to allow you to trade property for more discounted property. You buy one house for 40, put 10 in, you're in for 50, you sell it for 100, you find 2 more houses for 50 each to do the same thing with over and over and over again. So you refi 1031 until you die, essentially. When you die, there's a way to out of paying the taxes on the gains too. So that's category number 1. That's the unrealized gains. Now the other category, you want to use both of these, right, to the best of your ability, are the losses you didn't really lose. They're losses you get to claim, but it's not really money that you lost out of your bank account, right? There's 2 real components to maximizing this whole unrealized losses, non-cash losses thing. The first one is depreciating your property. Now, this is kind of a complicated subject. I'm gonna try to make it as simple as possible. Let's say you bought a house for $120, and $20K of the purchase price is the value of the land. The other 100 is the value of the building itself, right? Well, the IRS looks at that building and goes, hey, that degrades over time, so it's depreciable. It has a lifespan. That building is depreciable over 27 and a half years. Comes out to about $3,600 a year of depreciation write-off you could take on that property. And that's cute, but it's not a whole lot of money. So you want to try to squeeze more depreciation out of it. What do? Well, you could do something called a cost segregation study, and it is very literally what it sounds like it is. every component of the property, the roof, the windows, the flooring, the appliances, the HVAC, the driveway, the lawn, the fencing, all that stuff has a portion of that 100K value attributed to it. And each of those things has a different lifespan. And some of these things have shorter lifespans than others. So they can be depreciated over a tighter period of time, meaning you get more write-off pushed to the earlier time of your ownership. And if the lifespan's short enough, there's some incentives that the IRS allows you to depreciate the entire value in the first year. Now, some of those incentives are starting to taper out, so talk to your accountant about all these different depreciation methods available. But if you're able to segregate the cost of your property, then you're able to depreciate a certain amount of that 100K building value, not the land value, faster. So just for buying the property, you get to write off a good chunk of its value. Long and short, when I buy a 120K house, let's say, and 100K of the value is attributed to the building, I tend to get about 30K of depreciation write-offs when I accelerate in year one. And the other 70 I get to write off over the remaining years at a slower pace. It's pretty nice, especially if you buy this thing with a loan and you only paid $30,000 down to purchase it in the first place, and you get to deduct $30,000, so you're not paying taxes on the down payment money that you used for it. Now, that's step one of imaginary losses. Step two of imaginary losses is upgrades to your property. These can all be written off in a variety of ways. Upgrades and repairs. Upgrades can be depreciated, or new roof, new flooring, new appliances, those kind of things. And some of those things can be depreciated instantly, immediately, year one, the full value. And then repairs and maintenance, repainting, fixing leaky pipes, those kind of things, those can be expensed. Now, I know what you're thinking. Hey, this is actually money coming out of my pocket, so how's this an imaginary loss? Well, it's adding value to your property. If you bought it right and you spent money on upgrades, your property's worth more. So you're literally putting money right back into your net worth, but then you're writing it off on the way in. And then it's adding more value than you put in if you did it right. If you spend 20, you might have added 40 in value. The 20 of equity profit you made, that's not taxed either. So what am I trying to say here? If you can handle it, properties that need work can be written off much more aggressively. But if you can handle it, if you've got a good team, a good property manager, a good contractor, you get the right pricing, you know how to get the deals at the right price, you can stomach all the bullshit that comes with it, buying shittier properties and then upgrading them leads to more deductions on the front end than buying the property turnkey. I actually bought 2 3-plexes in the same month. One of them I bought for 80, I put 20 into it, worth 175. Same town. The other one I bought for 30, put 70 into it, worth 175, maybe a little more, 185. The property that I spent a ton of money on is going to be just a masterclass for my accountant to be able to put on my schedule, because the amount of write-offs I'm getting out of that thing, I'm depreciating the 30K basis, and then I'm going to depreciate or deduct all those 70K of various improvements and repairs to it. And it's going to be worth 175. If I wanted to get a loan for 100, I could easily get all my money back, have all that equity I didn't pay any taxes on. This is how you really snowball it, combining the unrealized gains with all the non-cash losses. But there's a note on non-cash losses I need you guys to understand. If you have a rental portfolio, let's say you have a rental property business that loses, let's say $100,000 after you do all these different tricks at the end of the year, that's considered a passive loss. If you're just a passive investor, if you're a W-2 dude, let's say you work for a tech company, you make a couple $100,000 a year, but then you lost $100 on your rental portfolio, you don't get to write off the passive loss on your rental portfolio against your active income from your tech job, your W-2 job. You only get to write it off against the passive income, the rent money that your rental portfolio made you. Now, if you have more losses than you do have rents, you can just carry it forward to future years and then use it later, which is great. But if you are paying too much taxes on your W-2 or on your other income, you want to be able to write your losses off against it. How do you do that? Well, passive and active don't mix. You can't write a passive loss against an active earning, right? But what if your rental portfolio was not considered passive? What if you can make that into an active loss? How do you do that? Well, the IRS says if you or your spouse is considered a real estate professional, they have to work enough hours in qualified trades in the real estate business. They have to have beneficial ownership. They can't be like an employee W-2 for like InvestwithACE, right? My employees don't qualify here. And they have to spend more than 50% of their total hours in a trade or business in these qualified trades. So 750 hours, more than 50% qualified trades. Obviously, it has to make sense. They have to maybe make some money in it, right? Or they can't make a bunch of money doing something unrelated. Then they're considered a real estate professional. If you're considered a real estate professional, then your rentals, it's all considered active also, including the losses. So let's say you have a flipping business that makes 2 million, and then you have a rental portfolio that had losses of 1 million. Then you can write off that $1 million of losses on your rental portfolio against the $1 million against the 2 million in income that you made in your flipping business, cutting your taxable income in half and allowing you to pay taxes on only half of what you really earned that year, not including all the unrealized gains that you got on that rental portfolio that aren't taxed either. And that's the recipe for how you end up paying taxes on only a fraction of your income using real estate. A lot in like 16 minutes of video. I wanted to make it under 10. Not that easy, but this stuff is all notepad worthy. So watch it over a second time, write it all down, take it to your accountant, pay less taxes, legal.